for a while. Inflation's been low, rates have been low. It was pretty clear at some point we would have more inflation. So as you think about that, you focus on investing in companies that have pricing power. You need price makers, not price takers. So the companies that we've been investing in tend to be on the better side of this, and that's in part why our portfolio has been performing quite nicely. But it is one of these things that we talk about a lot, but I think the overall sense is one of anxiety and question and concerns about where it's going.
And there's a lot of complex issues where they're coming to us not for capital, but really for advice and expertise, to Scott's point. So over the last 5 years, I can't tell you the countless conversations we've had with our CEOs about cybersecurity. It's one of the areas that our technology team and our growth teams invest very significantly. We have resources like General Petraeus at our firm, who is very, very knowledgeable about that whole ecosystem. So we get our chief risk officers together. We get our general counsels at our portfolio companies together, our HR heads together, to talk about tough issues like cyber, for instance, and try to bring them resources to help address that. When we talk about ESG and carbon footprint and what our companies should be doing, our CEOs are reaching out and saying, what are you seeing across your 200 companies? What are the ways in which you guys can help us actually implement strategies? It's not just about the measurement of carbon or greenhouse gases. It's about what should we do next.
Whether you get your news on TV, on the radio,
on Bloomberg Radio,
on the web, on the Bloomberg Terminal, or the Bloomberg apps, the news that affects your business.
So recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
Is our business. Bloomberg TV and radio. The world is listening.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I think about the idea of what Henry and George built, which again, we sit here among it in many ways. You guys obviously were a part of that, but now you're in the main seats. You are the CEOs of this company. So, of this firm, what does the Joe and Scott KKR look like that is different? What's the imprint that you guys talk about, because I'm sure you do, that you want to put on this firm as leaders?
I would say what's going to stay the same and perhaps what might be a little bit different. The most important thing is that our legacy around the firm's culture, the collaboration, being a magnet for talent because of our culture, that cannot change. We will absolutely not succeed as a firm if we lose that core part of our DNA. And that is Henry and George's legacy that we are very, very proud to be carrying forward. I think what will change is there's so many more opportunities for our firm to grow. We talked about the wealth channel today, the retail channel. Out in Asia, out in the emerging markets, so much growth opportunities for us. In real estate, in infrastructure, in the climate space, energy transition. The sectors that we can now invest in are so different than maybe 10, 15 years ago.
Yeah, the world's moving faster than ever before, so we have to be ahead of the trends. We've got to be really thoughtful about these themes and then move the entire firm to make sure we're in the way of where the wave is going as opposed to getting hit by it. That is a shift. The world is definitely moving faster. There's also more competition for talent, in everything that we do. And so we've got to make sure people have a fantastic experience here, and that's what we spend a lot of time on, is how do we make sure that we're creating an environment where people want to be, they feel like they have an incredible opportunity to grow, they get stretch assignments, they get mentored. I mean, how lucky were we? We joined this firm when we were 24 years old, and we've been mentored by Henry Kravis and George Roberts for the last 25 plus years. At the same time, we were in an industry that was growing incredibly quickly. I mean, that's a wonderful opportunity. We've been incredibly fortunate. We want to make sure that the Joe and Scotts that are joining now have the opportunities to be in these seats. And now there's lots of people doing this. And so we have to be special and different in a different kind of way, and then aggressively embrace change. Because if we don't, we're going to fall behind.
I want to build on that just for a second, because you said a couple things that sort of put me in a slightly different mindset, which is, you know, when Henry and George started this place, and really through the first few decades, there was a lot of embracing risk in many ways. This was a swashbuckling industry. This was a swashbuckling firm in many ways, and risk was really built in. As you get bigger and bigger, there must be a tendency to like play it a little safer. How do you hang on to that willingness to feel like, okay, we're going to do this at a time when the responsibilities are greater? You're not talking about 50 or 100 people. You're talking about 1,900. You're talking about all these different clients. How do you hang on to that edge, which is what made this such a successful and lucrative business over its history?
You got to celebrate risk-taking. I mean, we have a lot of people that have joined just even since the beginning of COVID. We're spending a lot of time talking about, you know, raise your hand, come up with a new idea. They're not all going to be great, but if we don't throw a bunch against the wall, we're not going to find the next big idea. You've got to have a culture where people know it's part of their job and there's a path to success from taking risk and thinking about what might be next. And what we then need to do is we need to celebrate it publicly when someone does that. We need to talk about it internally a lot so that people know it's, you know, not everything's going to work. Not everything we've done's worked. But if you're not trying, you're never going to have a chance.
Joe, that raises a really interesting question, which I think is, so what's the pitch to some extent? Because it's fairly, you know, straightforward if someone is showing up at Harvard Business School and saying, hey, I'm from KKR. Like, all right, I got it.
There are a lot of great firms out there, but reasons people self-select and want to come to KKR, it's not because of the capital base or anything. It's the experience they're going to have. It's the connectivity with the people, this culture of collaboration that we work every day to build at KKR. And those stories, you know, the social media stories, they ask their friends, what's it like to be an analyst at KKR? We have to deliver great experience so that word of mouth travels to all these 800 campuses that Scott's talking about.
Right.
And I think we've done a better job, but there's a lot more work to do on that front.
As we start to wrap up, I want to go back to this notion of the evolution of this firm that you have seen from the inside out. You show up in 1996, the two of you, and again, it's a well-known firm. There's a little book called Barbarians at the Gate that came out a few years earlier that sort of put KKR on the map and to some extent put the leverage buyout business on the map, for better and worse. And yet, still at that moment, it's a pretty contained, private industry. Over your time here, it has become, in many ways, the opposite of that. It is bigger. It is more influential. Your firm and your competitors are publicly traded. So what does that ultimately mean, Scott, for the responsibility that you have, and how have you seen the, let me ask the question in a more succinct way. How have you seen the perception of private equity change writ large, and what do you do to help tell the story?
Yeah, I think it's a great question, and I'm not sure we as an industry have told the story as well as it could be told. But back to the job hasn't really changed because the end result is performing for the people that are counting on us. And back to the responsibility point, we not only have the better part of the 20 million about the teachers, the firefighters, et cetera, but we also have 2 million policyholders that we work for through our insurance company. We've got countries, sovereign wealth funds that we work for. We have insurers that ultimately are working for individuals as well. And now we're expanding to go more direct to individual investors. So what we try to do is make sure everybody here stays focused on the mission. The mission is performing for the people that are counting on us. And let's focus on getting that right. because they need us to perform so that their lives are what they want them to be. So we try to make sure everybody's oriented around that. We end virtually every firm meeting actually with a picture of the people that we work for, teachers, firefighters, municipal workers, and we remind everybody, remember why we're doing this. That's the end result. That's what we're trying to deliver. For the industry as a whole, I'm not sure we've done a great job talking about that. You know, I think we could do a better job actually sharing what we're doing and the end result of all of this. How it has resulted in incremental benefits to the folks that are counting on us to actually perform for them. And the perception of the industry, I think we've allowed other people to define us maybe a bit more than we should. But what we're doing is not only performing for those individuals, we also, just in our private equity portfolio, we have over 800,000 employees. We've got to do a great job being good stewards for them as well.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Deflation is a terrible thing. Inflation you could tolerate.
You could trade anything as a trend fall.
When you think about Bitcoin, I don't think it's a currency. I think it's a commodity.
Today, we're in an everything bubble.
I'm Francine Lacqua. Welcome to Bloomberg Front Row. Andrea Orcel is a titan of European banking. At UBS, he transformed the firm's investment bank. He's now the chief executive of major Italian lender Unicredit. Over the course of his career, Orcel has had to navigate numerous crises, and now is no different as the world grapples with the most serious conflict in Europe since World War II, rampant inflation and aggressive central bank tightening.
Inflation is biting. We see for low-income or lower-income families really difficult to deal with the rising cost of energy.
The Italian has also faced personal challenges recently, including a dramatic and public legal battle with Santander over their botched attempt to hire him as chief executive.
I will always be sorry for how it went. This is another bank I admire a lot, and that hasn't changed. I think for me, it was more about confirming the facts. It was obviously an emotional roller coaster. I think from a family standpoint, it was quite impactful.
In his first TV interview since becoming chief executive, we talk about his new role at UniCredit, the impact of the war in Ukraine, the challenges of being Europe's bank, and that Santander debacle. Here's my conversation with Andrea Orcel. Andrea Orcel, thank you so much for speaking to Bloomberg. So you've been in the job just over a year. Was it everything you hoped for?
More.
Really?
Much more, yes.
Not stressful?
Stressful, but I like stressful. I think that what has been great this year is the way UniCredit really welcomed me into the organization. Mm-hmm. It was full of passion, full of warmth, and you feel the energy of the people around you. People that want a new vision, a new strategy, a new direction, and that are ready to commit and own the future. It was absolutely outstanding.
Did that surprise you? Were you expecting a more sleepy bank?
No, but I looked at it more from the perspective of a banker, numbers, what needs to be done, where is the value, where is not the value. But when you arrive, you see the people, and that makes the whole difference.
So that's what makes it more emotional, I guess? Is this like
probably. Somebody asked me once, what keeps you up at night? Well, the emotions are now very engaged, and you feel a duty and a commitment to the people who are looking up at you to take them in a certain direction. And that, I think, puts a lot of weight on your shoulders.
UniCredit's exposure to Russia is one of the top 3 in Europe. How do you deal with the employees in Russia, with your subsidiary in Russia?
Well, first of all, for us, it's important to understand that we have to remember that 95% of the bank is not in Russia. No. And we cannot commit the mistake of spending the entire time on Russia, where our emotion and the shock that we have taken is probably driving us to do. So what we have done is we have a situation room that is fully committed to do that, with all the skill sets that we need, from legal to tax to accounting to everything else. And they work on managing our exposure towards Russia. The rest of the team is 105% or 110% focused on running the rest of the equation. When I look at Russia, separating it, there are 2 orders of effects that we look at. One is the direct shock from our exposure to Russia. I think that in the last 2 months, we have achieved to reduce it meaningfully by about 2 billion. We've done that. Actually, the team has done a great job without that costing the bank almost anything, which was not to be expected. And at the same time, we have understood very well and in a granular way what the risks are. And we think that in Q1, we took a very conservative set of provisions to try and insulate ourselves the most possible from the further effect from a degeneration of that situation.
The provisions were quite large, and the market took it quite well. Is that how you would describe it?
I think so. I think what we did is, during those 2 months, we were able to articulate in a detailed way what is our extreme loss scenario for Russia, converted in numbers on hit on capital. It's about 130 basis points of capital. And in the first quarter, we took about 195 to be exact.
The question is now what you do with this unit. Are you frustrated that you keep on getting asked over and over what will happen to Russia and the employees there?
Well, I think that anyone who has a large presence in Russia or a significant presence in Russia is being asked. It's normal. I think we believe strongly that let us show you what we execute and let's talk about it then. Because at this point in time, while we have reviewed the situation, we have a number of options that we could pursue. The options are very much affected by the next wave of sanction, by who are the counterparts, what we can do, what we cannot do. And at the same time, we should not forget that we do have 4,000 employees in Russia. We do have 1,500 corporate clients. And what people sometimes forget is that 1,250 are actually Europeans who are trying to go through the same thing that we're going through as a bank, which is deal with a situation in the best way possible.
Do you have a preferred route? And actually, is there a situation where you just say, like, we need to get rid of it? What do you say to the critics that say, Andrea, you should have gotten rid of this, whatever the cost?
I think our view is, number one, my preferred route is not necessarily a route that can be executed. In the same way that we have given detail of how much of our cross-border exposure we have reduced, we could have reduced a lot more if it wasn't for successive waves of sanctions that have closed the window on who we can deal with, what transaction can we do, and in which timing. The same applies to our local presence. The solution very much depends on what is allowed to be done by a complex web of sanctions that we have and by who are our counterparties. We believe very strongly that if we want to be consistent with what the EU has decided, we need to consider all the options in a way that they reflect fair value, because this is a primary objective for not providing too much value to the counterpart, let's put it this way, that is not justified, and at the same time balancing what is in the best interest of our stakeholder and investors.
How worried are you about inflation, about the cost of living? You're so tied to the Italian economy, and this is an economy in terms of energy, in terms of also exports and imports with Russia, that's one of the most closely linked.
Well, we are tied to the Italian economy. We're less than people expect because we are about 40% of a bank. I think in my first year of operation, being tied to the Italian economy has been great. Good growth, good dynamics, stable direction of travel.
Is that the Draghi effect?
It is the Draghi effect. As we look forward, there will be a deceleration. We have two central scenarios for ourselves. One is a significant slowdown, and the other one is a deep recession. At the moment, we see a significant slowdown as the central scenario, although Europe has not been affected at all by spillover effects beyond prices. So what we're seeing is inflation being the precursor of more. Inflation is biting. We see for low-income or lower-income families really difficult to deal with the rising cost of energy. We also see that for companies that had investments or that were dependent on energy or on grain to a certain extent, the whole value chain has been completely destroyed. And so they need to reassess what is their position, change their sources, redesign their models. But at this point in time, this translates solely in a slowdown of investment. We haven't seen anything else. We do believe that going forward, it will be a lot more disruptive.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Do you worry about a policy mistake from the ECB? If you have this possible recessionary environment and they don't raise rates, what happens to inflation and what happens to all of your Italian clients or European clients?
Well, it's a very tricky economic environment for the ECB, but also in the US. Because on the one hand, you have inflation, but the inflation is generated by a specific segment of the economy, i.e. energy. I'm not that sure that raising rates a lot will cool that down because it's very concentrated and it is linked to a dislocation between offer and demand. The rest of the economy, however, we all agree that is slowing down and maybe tilting into recession. Raising rates creates an issue. So it's very, very tricky to manage. And yes, we're all concerned to finding the right balance. I think that getting to a more neutral stance towards the zero is probably okay. The moment you go up a lot from there, it depends very much on what the rest of the economy is doing.
I mean, we also have this widening spread between Italian BTPs and German bonds. How much of a worry is that?
Well, you always have a bit of that every time that there is a crisis, there is a so-called flight to quality, and that happens. I think that, like for many other things, we need to see how all the economies of Europe are going to perform, in fact, during this environment. And I think what I was telling investors the other day is if you look at Europe today, and we are 5 months into the year, you do not see any deceleration of the economy. You see inflation, you see a rise in rates, you see some very worrying sign, you anticipate a social and an economic impact from the war, but you're not seeing yet that kind of degeneration that the market is expecting.
What is the market looking at? I mean, this is like the market seems to be all over the place. We could be up, we could be down. Are we living through a correction?
Well, I think I read an interesting report from one of the organizations that covers us, that will remain unnamed here, but that was asked to do a parallel between the environment of today and the 70s on inflation, which tells you what kind of mood and worry exists out there. Personally, I don't think it's going to be that extreme because I think there are a number of amortizers. I mean, if you look at the facts, Italy has managed to redistribute or change the origin of its energy to a significant extent of its value chain. So we now go to Algeria, Azerbaijan, and other places to get a lot of the gas, or we will be going. If you look at Poland, they have found a way to deal with Norway. If you look at Bulgaria, they connected their pipes towards Greece and the gas that arrives from there. So Europe is adjusting. The question is how much time there is, but Europe is adjusting.
But adjusting is in a kind of earthquake way, because you could see if there's oil and gas embargo from Russia, what happens to this continent?
I think it depends on timing. That's why the economic environment that we're looking at, it depends on timing and extent of the breakage away from Russia and to a certain extent from Ukraine. If that is done very fast and completely, as you said, the impact will be quite dramatic. If that is done over a significant longer period of time, the impact will be less dramatic. Do we have a significantly longer period of time? I don't know. But that is the key. And we always talk about gas, but we also need to understand our dependence on other commodities, nickel, palladium, lithium, a whole of other things that the entire value chain was predicated on connections with Russia and grains, connections with Ukraine. And if that changes from one day to the other, the shock is very high.
You were talking about a political stability in Italy. We were joking about the Draghi effect. Do you worry that actually politics in Italy has always been quite messy, that this political instability comes back and hurts your bank?
Well, politics in Italy, if you're Italian, I'm Italian, are politics in Italy, but forever, Italians have been able to go through it. And I have a lot of trust in the country, and I believe the country has evolved in a certain way. And in a way, I am much more nervous about the more general impact on economy in Europe, the more general social impact on Europe, immigration, things like that, that are going to touch not only Italy, but the broader continent.
How much do you like taking care of risk? So I want to talk about, a little bit about what you're doing inside UniCredit. Do you feel like you're a risk manager? Is it about also cutting costs? How do you, you have one of the most generous plans actually for investors out there. How will you stick to it?
Well, I think, how will we stick to it? I think we have said very clearly that we felt that the execution of UniCredit Unlocked would yield to a certain level of profitability, a certain level of organic capital generation. Based on that, we could have very generous distribution to our shareholders.
Was that pre-Russia?
That was pre-Russia. So effectively, the plan anticipated that our capital will remain stable through the period at the top end of our peer group, and that we would distribute only the excess capital we would generate every year. So in that way, it is prudent. It is subordinated to us executing the plan and all of its levers. At the same time, because of where we're coming from, there is a lot of value to be created. So that is what generates the distribution that we have. Then we get to the invasion of Ukraine. At the moment, what we have done is we have changed our macro scenario of reference from what it was before to a slowdown. From a GDP standpoint, it brings about 2 to 2.5 points lesser GDP growth than we were anticipating. From an inflation standpoint, it takes to a couple of percentage point more inflation than we were anticipating, with peaks in certain countries, obviously. In that environment, we can still execute, let's say, the UniCredit Unlocked plan as it is, if we keep our eyes on the ball and execute as we should be. Because in a way, the GDP deceleration is in part compensated by higher rates, which are good for banks like us.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
You've had one of the most colorful careers. I don't know if that's the right way to describe it. I don't know how you would describe it, but certainly in the 5 years, it's not been dull or boring following your career moves. Do you feel vindicated that you were awarded that amount of money with what happened with Santander?
I think I will always be sorry for how it went. This is another bank I admire a lot, and that hasn't changed. I think for me, it was more about confirming the facts, confirming the truths that I knew existed, and that has been done, and it's uncontroversial. I mean, you will find it black or white through the process that has happened. That, for me, was very important because a number of stories were written at the time. What happens then, I mean, obviously Santander has appealed, we'll see. But for me, the important point was that the truth is there, the facts are there, and at least mentally, I have moved on.
I mean, your case is probably studied in universities, eh? Because people want to know how they're paid. You know, I think 68 million without never starting a job, but also to try and understand what labor laws and everything like that works. Do you think it's changed the way we look at banking laws and banking?
I don't know if it has changed. What I know is that we shouldn't forget that banking is a highly regulated industry. As a result of that, senior jobs have a very large component of deferral in their compensation. In the UK, it's 7 years. And more than 50%, if not 60% in certain cases, of your compensation is deferred over 7 years. If you do the math, that means that at every point in time, you're going to have between 3-4x of your compensation deferred. And that is indexed to the share price of the bank where you are. And if it goes up, those 3-4x becomes even more. The difficulty is when you change organizations, what do? You either have the new organization that assumes that deferral, or you don't move. Because in effect, that deferral is your entire savings. So I do think that although these are large numbers, they need to be put in context of how they got there. Usually, in most cases, in all cases, the organization who hires assumes that liability or deferral. So that number is that liability and deferral, is plus a few other things that occurred because of the case, but that is what it is.
Was it an emotional roller coaster? Is it something that you've put behind, or is it something that you don't think about?
Well, at the beginning, it was obviously an emotional roller coaster. I think from a family standpoint, it was quite impactful, and I think personally, given the esteem I had for that bank, it was quite impactful. I think the important point was once I went through the preparation of the case, I detached and I left other people deal with it, and I was quite fortunate that those people were excellent. And then I trusted the process. A lot of people told me not to trust the process, but I did, and it ended up being worthwhile.
Andrea, talk to me a little bit about your working from home policy. So do you think COVID has changed everything? Is it problematic for a bank to let people work from home?
Let's say that what COVID has done, both from the standpoint of clients and for the standpoint of employees, is more remote, more agile, more flexible. I think that is not a bad thing. I think it has taken away FaceTime. To a certain extent, I believe strongly that being at work is important. That's how you establish the culture. That's how you train people. That's how teams can interact with each other and brainstorm and come up with a good idea. On the other hand, and we had started to do something similar at UBS at the time, you need to give people the flexibility to organize their lives, and you cannot say it's 9 to 5 or it's whatever it is, and that is it. So if you allow that flexibility for people to organize their lives, and if they need to take a Friday morning and then see the soccer match of their children, and then work longer on the Friday evening, that's their choice. But I don't think you can replace human interaction, brainstorming, teamwork. If you look at the agile way of developing our new initiatives around IT, they come from representatives from business, technology, compliance, risk, all being in one room. And instead of saying you do pieces, how do we resolve the mortgage product? You can do that in the office. You can't do that remote.
Talk to me about attracting talent. So do you worry about some of the bright young minds going to JP Morgan, Goldman Sachs because they pay more? Or do you worry about them going to crypto or Google because it's exciting?
Well, I think what I have found is that the bright minds are as attracted by money as they are, and probably more, by what's the vision, what's the challenge, what do I learn? Is this company doing things that I am proud of? Do they care for the environment? Do they care for the communities? Will I be followed in my career and developed, which is why we just launched the UniCredit University. These things, especially in the early years, take quite a lot of space in their decision. As they move through, and they come in and they move through, then what takes place is, how do you treat them? How do you track their career, manage their career? Do you give them opportunity? That's why I think we're very fortunate at UniCredit. I can have a young person from Bosnia who starts in the leading bank in Bosnia, does a tour into Austria, Italy, Germany, Serbia, and then with a skill set that has been refined, goes back and leads the bank in Bosnia. Not many groups can do that. And I think that's one of the attractions that we have.
What do you like most about being chief executive?
Trying to make a difference. I have been told by many people that, no, this cannot be done, or this is difficult. This is a little bit my chance to try and do what I think it's right. What I think it's right is usually I get it from talking to people who, and if I can make a difference to UniCredit and to the 80,000 people that are there and look back and say, yeah, I helped move it from here to here, and I helped establish what are our principles, what we stand for, I think that will be a win.
If the Credit Suisse chief executive job came up, would you be up for it?
I love UniCredit too much.
Andrea, thank you so much.
Thank you, Francine.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I think in investing, you're going to be wrong a number of times, but you've still got to take the risks. The more issues there are in the economy, or the more issues there are with people, that's beneficial for what we try to do. So I just focus on things I can control, not things I can't.
Mark Lazary is a champion in both investing and basketball.
When you're investing, you can control a lot more things. On a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
Lasry, a trained lawyer, is considered a pioneer in distressed investing.
I'm pretty simplistic about these things. I'm like, look, here's what the law is. Here's what we can do. Let's try to cut a deal that's fair.
He started his firm, Avenue, with his sister Sonia Gardner in 1995 with less than $10 million in capital. Today, the firm manages $12 billion in assets.
She is focused on making sure the firm runs well. I end up getting to do the investment side, which is what I love.
His love of basketball led to one of his greatest deals. In 2014, Lasry and a group of investors purchased the Milwaukee Bucks for $550 million. Today, the team is valued at $1.9 billion, and last year took home the championship.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky. You've got to be really, really good, but you also have to be really lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
Let me ask you about distressed debt for a moment before we get back to basketball. Distressed debt implies that there's some company under stress usually, but for the last couple of years, there hasn't been that much distress. So what have distressed debt investors been doing with themselves other than buying basketball teams?
There hasn't been. You're absolutely correct. So what we've done is gone into the private lending business. So I think investors want to try to make anywhere between 10 to 15%. And so our business has dramatically shifted over the course of the last 3 to 5 years to now we just lend money. And we're lending money anywhere between 8 to 12% at a senior secured level. And then you'll do a half a turn of leverage. So it actually it's actually worked out really well.
And do you expect, because interest rates are going up and inflation is up and the economy may be slowing down a bit, that there is going to be more distressed debt in the next 1 or 2 or 3 years than you've seen the last 1 or 2 or 3 years?
Absolutely. I mean, with rates rising, that's actually good for us because the more issues there are in the economy or the more issues there are with people, that's beneficial for what we try to do.
So let's talk about your background a moment. You were born in Marrakesh?
Yes.
So your parents decided to move to the United States, and you're young. And when you came over here, did you speak English at all or nothing?
No, not at all. I was actually, I went to a public school in Hartford, and because I had dark hair, I was with all the kids who were Hispanic. They thought I was Hispanic, so they were speaking in Spanish, and I was trying to learn English, so I was all confused.
All right, so you were a high school basketball player?
The legend is that I was, yes.
Okay. But I thought you went to Clark University and played basketball there as well.
I did, but Clark was Division III, so I played, and by my sophomore year, I realized I wasn't that good. So I then played in the club, the club teams, and I did really well there.
Okay, so, well, you weren't able to dunk the ball, I assume.
I could dunk a volleyball.
Really?
Well, my hand wasn't big enough for a basketball. I could jump.
My theory has always been that if James Naismith was Jewish, he would have made the hoop a little bit lower.
Probably.
Right. All right, you graduate from Clark, and then you go to New York Law School?
Yes, sir.
And then you started practicing law?
So I clerked for the chief bankruptcy judge. And then because I did that, I'd done well in law school. So because of that, I ended up getting offers in bankruptcy, right? I thought I was going to be a tax lawyer. I was always good with numbers, but since I clerked for a judge, and I got all these offers to do bankruptcy law, so I did that.
Okay.
And I practiced for about, I mean, it was a long time. It was about a year. That was enough for me.
All right. Well, I practiced 2 years. That was
okay. So there you go.
Yeah, twice as long. So, all right. So then, what happens is you decide to get in the investment business. And how did you segue from practicing law after 1 year into the investment business?
So I went to work at a firm. That was an investment firm, small firm, and at the end of the year, I was making $50,000, and at the end of the year, I had shifted over to the investment side, and I had made the firm $25 million. So this is in '86, and you're all excited, you're going to get a bonus, and I call my dad, and I'm trying to figure out, what do I ask? So my father says, well, don't be greedy, ask for half of 1%. So I asked for $125,000. And I thought, that would be great. And I had a child at the time. And the person who's giving me the bonus goes, well, how much do you want? I said, $125,000, I think would be fair. And he goes, no, we're not going to do that. I was like, oh, okay, how much? And I don't know if you've ever had this in your career. Somebody stands up, they put their arm around you. It's called an attaboy. You're doing really well. He goes, we're going to give you $10,000. I was like, okay, thank you. And then I left 3 months later, and I went to work at Cowen and Company.
Okay, so how did you raise your initial capital, though, to start investing?
So I went to Cowen, and the partnership at Cowen gave me $25 million. We did about 60% a year for about 2 years. And somehow I got on the radar of the Bass family and somebody who you know, David Bonnerman. And they asked me to come over and run money for the Bass family. And then in 1990, I left and went, I was 30, so I was old. And I left to go off on my own, and I started investing my money. I had made with the Bass family about $10 million. Okay. So I gave my wife half and said, never give me this.
So you started the firm with your sister.
Yes.
And it's very unusual to see brother-sister financial partnerships, I guess. I don't see that many of them. So what's it like working with your sister?
It's actually great. It's I think you can only work with a sibling if you're really different. I think when you're similar, it's very hard because you want to do the same things. I think when you're different, she manages the firm. She's general counsel. She is focused on making sure the firm runs well. I end up getting to do the investment side, which is what I love, and the marketing side. So the things I love, she doesn't, and things she loves, I don't.
And you have another sister in the business?
Yeah, we have one more sister who out of the three of us is probably the smartest one, but she joined 10 years later.
Oh.
So,
do you have any more sisters in her company?
No, that's it. I just had two sisters.
And so you seem like you're a fairly laid-back guy. You're dressed very casually and so forth. But I always thought distressed debt investors are very nervous people. They're pounding on the table. You don't have that characteristic, or you'd have somebody else do that for you?
No. I think people are usually pretty smart. So I like to explain what the situation is. And I think when we talk to people, we'll say, look, here's what you can do. Here's what I can do. There's a 90% probability I'll win, but there's still 10, so I'm willing to settle. I just sort of try to go through all the facts with everybody. I think other people, I've had folks, where they'll come in my office and say, if you don't agree to this, we're going to out of you. We're going to make your life utterly miserable. And you'll go, okay, all right, good luck. I guess we're going down that road. I mean, I don't take it personal. I think I know what will end up happening, or I assume I know, and there's a probability of that. So I just focus on things I can control, not things I can't.
So have you ever made a distressed debt investment, didn't work out, you actually lost money? Does that ever happen?
Yeah, it's horrible. Yes.
So what do you conclude was the mistake you made? You're just too optimistic about something?
Well, I think that the business itself changed. We thought we were covered on the debt side. And then what normally ends up happening is The company needed more cash, so we let the company borrow against that because we didn't want to liquidate the company, and just, we were wrong. And I think in investing, you're going to be wrong a number of times, but you still got to take the risk, so that's fine.
So when you lose money, it's pretty depressing. You just go on to the next thing, or do you think about it for the next 30 years, as I do whenever I do something?
I don't think about it for 30 years. I'll focus. I mean, it's probably after a couple days, I'm over it. I mean, it's.
What about your best deal ever? Without mentioning the name of it, perhaps you don't want to embarrass anybody by saying how profitable your deal was compared to what they did, but what was your best deal? Make 5 times your money, 10 times your money, something like that?
I think our best deal for us was something where we made 30 times our money, where we had bought the bonds at 2 to 3 cents, and the bonds ended up becoming worth par. So that was great.
You have any more like that?
I'm looking for them. Trust me. I have a pretty good relationship with a lot of the players, so I'll just go in and say, look, you stop worrying about it. Just shoot. It'll go in. If it doesn't, it's not the end of the world. We'll lose and we'll all go home.
Billionaire investors lured to the NBA owner's box are now reaping the rewards of their financial bet. Mark Lazary and Wes Edens purchased the Milwaukee Bucks for $550 million in 2014. Now the team's value has more than tripled to nearly $2 billion. And other deep-pocketed investors have seen similar appreciation. In 2021, the value of the average NBA franchise rose 9% from a year earlier to $2.5 billion. And while winning drove value for Lazary's Bucks, it's not required. The Knicks have won only one playoff series since 2000, and yet they remain the NBA's most valuable team, worth $6.1 billion.
So you're managing your company, your family's money, you've got 2 sisters, everything is going well. Why did you want to buy a basketball team?
I wanted to buy a basketball team at the time because I had played. I loved it. I thought it was fun. I was about 52 years old. We wanted to try to do something with the family because my kids all played basketball. So the Milwaukee Bucks came up. That was the good news. The bad news is they were in Milwaukee. So it was a bit far to go, but they were the only team, and so we got involved, and we were able to buy it.
Were you bidding against other people?
We were. We actually were. I think we were $100 million over. Somehow, you hate when you find out that you
were prepared to pay $100 million more than the next bidder?
No. We found out that the next bidder was at $450, and we were at $550.
Oh.
And
so did you lower yours to $451, or?
I wanted to, but they said they wouldn't accept it. I was like, I don't understand. We're $100 million over. Why can't? How about $500 million? They were like, no, it's $550 or you don't have it.
So what did you do?
I caved. I shouldn't have, but I did. And
but the team is now worth over $2 billion or something?
Yes.
So it's a pretty good deal.
Yeah, it's so the part that's actually shocking, when we bought the team, it was making $5 million, so we paid 100 times. So today, you invest. If I said to you, hey, 7 years later, the team's going to be losing $5 million, what do you think it's worth? You wouldn't have said $2.5 billion.
So when Steve Ballmer came along and paid $2 billion for the LA Clippers, I guess everybody in the league was happy, right?
Oh, I was thrilled, yes. I thought it was the greatest thing. I was like, yes, good trade.
So when the team is not doing that well, would you ever go in and give a win one for the Gipper speech at halftime? Do you ever go in and kind of tell them win one for the owner?
No, that I don't do, but I will go in. I have a pretty good relationship with a lot of the players, so I'll just go in and say, look, you stop worrying about it, just shoot. It'll go in. If it doesn't, it's not the end of the world. We'll lose and we'll all go home. But it's just more cheering people up.
So one of your best investments has obviously been the basketball team.
Yes.
So are you thinking of buying any more sports teams, or?
No, they're expensive now. They're very expensive.
Now, recently I think I read that you invested in a sports betting app.
Yes, Lucra.
Now, tell me why you're involved in that, and how much can owners of NBA teams invest in sports betting things?
Yeah, no, you can. You can invest in a lot of things that the NBA is involved in. You just can't control it, so you can be an investor. So I invested in that. I actually bought another franchise. I bought a pickleball franchise. So have you ever played pickleball?
I've heard of it, but I haven't played it yet. But
it's like
there was a franchise you got. I thought it was a sport you just played, but you played.
So
teams?
They just started a franchise. And they just started a league, pickleball league. It's like the fastest growing sport, and I play it all the time just because it's easier to play. But then a friend of mine, James Blake, said we could buy a team, so I bought it with him.
Wow! So that was less than $550 million, I assume.
Yeah, it was less. Yeah, it was less than $1 million. You're gonna make mistakes. Understand that. Make your mistakes, because the only way you will ever make money is by taking risks.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
You're an expert in debt investing.
Yes, sir.
And you like distressed debt investing.
Yep.
The U.S. government has like $30 trillion of debt that some people might say sort of distressed. Are you worried about the U.S. government's ability with higher interest rates to pay off this debt without deflating the value of our dollar?
Yes, I actually am. I think that's going to be an issue. I don't think anybody's going to focus on it. They'll start focusing on it in 3 to 4 years. I mean, as rates move up because of the debt that we have, the cost of servicing that debt is so expensive. It's going to be an issue, but for whatever reason, people don't want to focus on it.
But do you buy government securities or debt around the world? Do you buy debt in other countries?
No, we don't. It's got to be a company, because we've got to be able to do the work. I think when you're buying government securities, that's a macro call.
But the general economy itself, now as we talk, there's a war in Ukraine. Is that affecting the economy in your view? And are you worried about the economy and potential recession?
I think it's obviously creating issues. I think as oil prices move up, the cost of that for the consumer becomes higher and higher, obviously, and that'll create, I think you could have a recession. I think right now we're probably growing at 1 or 2%. But if things slow down, I mean, the Fed is raising rates, oil's going up. We'll see where things are in 3 to 6 months. But you could be in a recession. I mean, a recession is 2 down quarters, so it wouldn't be till next year. But I think things are definitely slowing down.
So do people in government, there's a Democratic administration now, you're well known to a lot of Democratic figures. Do they call you for advice, or do you go down there and tell them what to do, or how does that work?
Yeah, they'll call. I go down there, and the great thing is they don't listen. So it's actually, I don't know if you've ever found that, but you give your advice and people go, oh, thank you, and then you leave.
What about members of Congress? Do you talk to them very much about what's going on?
I'll talk to some. I will, but I think part of it is, I think there's a view that you've got to keep on spending, right, and that you need to do that. And I don't know if I disagree with it, but it's going to create a lot of issues.
Let me ask you this. Sometimes I have friends in the distressed debt business like you, and they don't like to say this to me, but let's suppose my firm does a buyout. And they actually don't want to tell me, but they think it's not such a good buyout, and they start buying my debt at a distress. Do you tell your friends in the buyout world, guess what, I think your debt isn't going to be so great, and I'm buying it now at distress because I think you're going to go bankrupt? You ever tell your friends that?
All the time.
And
I've gotten no problems. Yeah, I mean, I'll say, look, you own the equity, I own the debt, so I think I'm senior. Your debt's trading at 60 cents, so theoretically your equity is worthless. And they say to me, no, actually, you don't understand what we're doing. We're going to turn around. I'm like, so why don't you buy the debt? I go, are you kidding me? If I'm right, I wouldn't want to go from 60 to par. I've got the equity. That equity is going to be worth 5, 10 times. You know, everybody, I think as a credit investor, I'm very happy making 2 times my money or 1.5 times.
Let's suppose I say, I don't really know much about the investment world. I want to double my money over the next couple of years. Would I be better off to go into a buyout firm or a distressed debt fund?
A buyout firm. I would. I mean, I think because I'm going to be limited. My average cost is usually 60 to 75 cents, right? And for it to work out, it's 2 to 3 years. A buyout, when you're right, you know, you'll make 2, 3, 4, 5 times your money because of the leverage.
Okay. So what is the best investment advice you've ever received?
I think part of it was from David Bonnerman. It was like, when you make a mistake, just move on. Don't learn from your mistake. Don't focus on like all the things you did wrong. You're gonna make mistakes. Understand that, make your mistakes, because the only way you will ever make money is by taking risks. And I think in the beginning I was a lot more conservative, and I've become a little bit less conservative because of that.
I wish I'd had that advice. I focus on my mistakes for about 30 years, then I get over them. But what do you think is the biggest mistake that the average investor makes? Is it selling too soon, or not going with the right group? Or what do you think the average investor's biggest mistake is?
I think the hardest part is giving money to people who don't know what they're doing. I mean, I'm always amazed at that. I'll always meet with people I went to high school with or college, and I'll ask them what they're doing their money, and they'll tell me, I'm like, oh my God, I would never do that. Like, put it into a fund or do this.
What about your basketball players? I mean, basketball players aren't famous for being great investors, I don't think, but maybe yours are good.
No, it's the same thing. I mean, you would be shocked. It's exactly what you said. So I spent a lot of time with them explaining where they should invest. You know, Giannis had a great line. He was at our house one day, and we were talking about investing, and he said, he goes, where do you keep your money? I said, well, my money's at JP Morgan. I go, where do you keep yours? He goes, 50 different banks. I was like, what do you mean 50 banks? He goes, 50 banks. Because I do it up to the insured amount. And so I got to make sure my money's insured. And part of that is because he's from Greece. He was worried about banks going under. I'm like, Giannis, you can't be like having accounts at 50 different banks. Like, let me tell you something, if JP Morgan goes under, your little dinky banks are going to go under too. Like, let me explain what you should buy. You should buy US Treasuries. You should buy this. And it actually was fascinating. Just, you've got to spend time with them for them to understand all this.
Now, if somebody says, I want to be the next Mark Lasry, I want to be a great distressed debt investor and own an NBA championship team, I don't know whether they want to do the former or the latter, more probably the latter, but let's suppose they want to be a distressed debt investor. What do you advise people to do to get trained to be an investor? Is it just do well in school, be good with numbers, be willing to litigate? What is it that you need to do?
I think it's a mixture of everything. I think you have to do really well in school. I think that's number one. I think you have to be really good at numbers. And then I think you need training. And, you know, whether that's going to work at a firm like yours or Goldman or Morgan Stanley, have like 2 to 3 years where you're in a program. And then, you know, I think we like to hire people after they've had some sort of training for 2 to 4 years.
And the greatest pleasure of your life today is your grandchildren, your children?
It's my children. I would tell you my children, my grandchildren. I get so much joy from that.
And you think you can repeat as NBA champion?
Oh, yeah, absolutely.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
We at Hall Capital are really disciplined in terms of sticking with investing with the very best. The way that we completely view the world and build portfolios is with long-term returns in mind. And I think you have to actually have the belief in your ability to make judgments and do it.
It seems that Katie Hall couldn't have ended up anywhere but Wall Street. There was her aptitude for math and her choice for a final project in school.
I wrote my thesis on an explanatory pricing model of Treasury bill futures. I mean, come on, really.
After studying at Princeton and Stanford, Hall spent over a decade working in risk arbitrage.
I know how hard it is to be great at any sector of investing, whether it be venture investing or risk arb investing or global equity investing.
In 1994, as the risk arbitrage market dried up, Hall moved into money management, starting Hall Capital to manage the portfolios of wealthy families, foundations, and endowments.
What I had then, and I think we have now, is sort of an independent perspective.
Today, Hall Capital is one of the world's largest firms of its kind. It manages about $50 billion in capital and has 200 employees.
We have the capacity and the scale to be a world-class investor, but we have a scale and size that permits us to have very close, boutique-like relationships with our clients.
I'm here with Katie Hall, who is the founder and co-chairman of Hall Capital Partners, which is one of the largest women-founded firms in the money management world. Is that right?
That's correct.
And when you started this, did you realize you'd be one of the biggest firms that was started by a woman in the money management world?
No, not at all. I mean, I think it was one of the beginnings is really about just setting up a good firm and building something that would be the best in the business.
So exactly what does Hall Capital Partners do? It's called an OCI by some people, which is explain what that is.
So an OCIO is an outsourced chief investment officer, which actually isn't really, in my opinion, the greatest term. And it really is sort of setting up as opposed to having an in-house chief investment officer. We really act as the chief investment officer and the investment team for our clients, who are foundations, large pools of family capital, endowments. And we really work very closely in partnership, managing investment portfolios.
So if somebody says, I'd like your services and I want to have an outsourced CIO to kind of manage my money, what kind of rate of return do you tell them you can get for them? Is it a 10% rate of return, 15%, 5%, or it depends on what their risk profile is?
Returns are completely dependent on asset allocation. And then, of course, what are the choices that you're making within that asset allocation? So it's really a blend of what are the different components, whether it be fixed income, equities, hedge funds, private equity, venture capital. What we do with our clients, we don't start from the presumption that there is a right answer for an asset allocation. We really spend a lot of time trying to figure out what's the right roadmap, what's the right plan for that particular situation, and then go from there.
So you don't actually sit at a trading desk and trade for your clients? No.
I don't.
So what you do is you pick good managers. What are you looking for in good managers? People that have a long track record, or people that are starting out fresh and they're really hungry, or what are you looking for?
I think there's a couple of things that cut across all asset classes that really are markers of superior investment managers. One, and what we're looking for. One, we actually start with the opportunity set. We only want to be investing in places that we think on a go-forward basis have attractive return potential. We then really are looking at people, firms that have the capacity to take advantage of whatever the opportunity set is, that have the track record, have the ability, have the experience, have worked in that field, that have a very clear, disciplined investment approach. That are themselves as an organization are set up to actually capitalize on that opportunity set. We look a lot at incentives in organizations, like how people are rewarding themselves to see if they're set, that just the overall organization is situated in a way that permits them to actually increase the odds of success.
So as we talk today, inflation is very high. It's likely that interest rates are going to go up and continue to go up for a while. Does that make you nervous about the next year or so in terms of investments? Are you changing your strategy because of what's going on in the inflation and interest rate world?
Our core investment strategies and the way that we completely view the world and build portfolios is with long-term returns in mind. And that is the prize. That's what we're looking for, is long-term compounding returns. So we tend not to adjust kind of for shorter-term gyrations. Now, that being said, I do think we are at a point of really fundamental change. I mean, think about it. It's been a decade of basically free money with a whole bunch of consequences of that, including some probably severely inflated valuations in certain sectors. You could argue there's been, what, 40 years of structurally declining interest rates, and that has come to an end. And I actually do think that is a really important thing. And we've been thinking a lot about positioning portfolios, not just now, but over the past several years, about how to position portfolios to actually have the resiliency and be positioned to participate in growth over the going forward 5, 7, 10-year return.
Now, as we talk, there's a war going on in Ukraine, and it's obviously changed people's perspectives on many things, including the energy supply chain and food supply chain. Does it affect the way you advise your clients, or it doesn't really have that much big of an impact?
You know, in the short term, no. But I think that's another really important global factor. You know, we think a lot about just the broad context of which portfolios are built and in which we're investing. And I think that the issues that are created by rising energy prices, rising food prices across the emerging markets, across Africa, across the Middle East, it's a very severe and potentially destabilizing set of factors. And so just as we, think about in a completely different set of vectors, the impact on sort of economies, on portfolios of sort of geopolitical tensions with China or relationship with China, so too I think that the changing stability of governments and sort of the mapping of that has a potentially a really significant impact on just how economies will look going forward over the next decade.
The economy in the United States seems to be doing okay, but there's some people that say there might be a recession a year from now or so because we're raising interest rates, and in the end, that will probably slow down the economy. Are you worried about a recession?
I think that we are definitely in for a period of, if not an actual recession, at a minimum, a re-rating of valuations that is sort of related to increasing rates and slowing growth. I think that the parallels to what we are seeing to 1999, it's different, but there are some definite analogs, is something that we're very mindful of. And it's getting back to this idea about focusing on the long term and making sure that our portfolios are situated to participate in that and not being overly distracted by short-term volatility, but yet being mindful that there is definitely shifts that are happening in the overall landscape and we need to position against that. I think this is an environment that will lend itself to some real innovation and some real system change.
Galvanized Climate Solutions. It's a firm co-founded by Katie Hall and billionaire Tom Steyer to raise money for the fight against climate change. The goal is to invest billions in companies and organizations working to curb carbon emissions. Some high-profile investors have joined in, such as billionaire Mark Benioff and Emerson Collective, an investment philanthropy founded by Lorraine Powell Jobs. Hall and Steyer see a need for what they're doing. Galvanize says that over the next 30 years, the world will need to invest about $4 trillion a year in energy transition technologies. Spending now is about $800 billion, which gives Hall and Steyer a big gap to fill. One of Galvanize's first investments was the routing company. It's bringing the ease of ride-hailing to buses and vans.
Now, you're also involved in climate change-related issues. And with your old friend Tom Steyer, you have built an alliance to kind of invest in climate change-related companies. Explain exactly what it is.
So when we created the company, we really had this vision that there was both a huge need and opportunity to be able to marshal probably substantial amount of capital to orient it, private capital, to orient it around helping to accelerate climate solutions. This is a critical decade that we actually have to make real progress. What we're doing with Galvanize is we are building a platform with quite deep expertise across science, across technology, across policy, across communications, across finance, that will then support a number of different investment strategies, from venture capital to public equities to everything in between. All of these will be strategies that will be oriented around investing against, again, solutions and generating, we believe, market returns.
Is it a for-profit venture?
Absolutely. It's really, we think that it's important that capital come into the system, that capital invest for climate solutions, and that actually get appropriate returns for that, so that we actually can then attract more capital to help, really create that proverbial flywheel effect.
So Tom Steyer is known to many people as somebody who ran for president and who's also a big environmentalist, and so you've known him for a very long time.
Tom and I were analysts at our very first job together at Morgan Stanley, so we have known each other since 1979.
And so today, when people talk to you about the environment, you basically say to them, this is an important issue that they really need to deal with, and your new organization will help deal with it?
Exactly. But it's actually something I think that we are seeing. The environment, excuse the pun, has really changed. We're seeing the capital markets are actually demanding that companies actually make progress on climate solution. We're seeing investors look for that. We're seeing actually customers of businesses demanding different kinds of activity. We're seeing employees. We're seeing people that want to work at companies that actually have a much more explicit mission about that they're trying to accomplish. So I think this is an environment that will lend itself to some real innovation and some real system change.
Do clients come to you and say, look, I want the best rate of return I can legally get. I'm willing to have you look at ESG, but that's not my main thing. My main thing is rate of return. Or people say to you today, ESG is very important to me and rate of return is secondary.
Yes, but I actually think that's still the wrong framing of it. That still implies that you actually have to expect to give up something to have a full incorporation of environmental, social, or governance characteristics. I just don't believe that. I think that actually the best companies are those that are making the most effective use of their human capital, their physical capital, their financial capital, and they're companies that are thinking about them actually will probably be the most successful companies and maybe the most interesting investments.
Let's talk about how you got into the business. So when you were a little girl, I assume you didn't say, I want to be a money manager.
No, I did not.
Okay. So where did you grow up?
So when I was younger, my family lived in Minnesota, and then we moved to Rye, New York when I started high school, and I really consider Rye my hometown.
So you must have done reasonably well in high school because you went to Princeton, right? And what did you study at Princeton?
I took a winding path there, too. So I started as an engineer and found it a little nonverbal for my taste back in the day. So I switched to English, and that was too many words. So I ended up majoring in math track econ.
So you graduated from Princeton. What did you do then? You say, I want to be in the financial world?
Well, I was looking for a job. I actually had done I wrote my thesis, oh my goodness, on an explanatory pricing model of Treasury bill futures. I mean, come on, really. So I was actually looking for something in finance, and I actually looked at some jobs on futures exchange. I ended up getting a job as an analyst at Morgan Stanley.
And you went to Stanford Business School.
I did went to Stanford. Stanford was much more appealing to me. It had a much more flexible curriculum. You just didn't have to approach things in just one way. Cases, for example, it was a much more flexible approach in terms of what you did. And I took a very flexible approach to business school.
So did you say, I want to start my own money management firm when you were at Stanford Business School?
No. I actually came back to Morgan Stanley, and I worked for the next 10 years in risk arbitrage. So I worked at Morgan for 2 years in risk arb. Then I moved to California to join my partner and friend, Tom Steyer, as he was setting up a company then called HFS Partners that became Farallon. And then I, in '89, established a risk arbitrage joint venture with Montgomery Securities.
But you also were in the buyout business for a while. Were you not a partner, or were you at Hellman Freeman?
I was a partner at H&F, but it was really because of the adjacencies with HFS Partners. So my day was really focused on the risk arb side of the business.
All right, so you're in risk arbitrage, you're working at Hellman Freeman. When did you say, I've had enough of working for somebody else, I'm going to go start my own firm?
In '89, where I formed this joint venture for risk arbitrage with Montgomery Securities. So that I was like, I said, well, it's time for me to be in charge. So I set up that business, truly with like the shockingly terrible timing. So think October 1989. That was when the United Airlines buyout blew up, which we got through it fine financially, but that literally stopped merger activity on a dime for about the next 5 years. So I had this sort of small risk arb partnership that I'd set up that we were, but there was just not that much to do. So I sort of toiled away for the next 5 years, kind of waiting for the environment to change. And then it was really in '94 when I was talking with Warren Hellman, who was the biggest investor in our partnership, and as an incredible friend and mentor. He said, well, why didn't I work with his family the way that I was working with another large family already? And I basically said, why not? That truly wasn't my opening business plan. So I ended up liquidating my ARB partnership and enrolling the general partner into the beginnings of what Hall Capital is today.
You were the chairman of the board of Princeton University, your alma mater, for 10 years.
8 years.
8 years. Were you the first woman to be the chair?
I was.
What was that like? How much time does it take to be the chair of the university board at Princeton?
We know there's a difference between being sort of chairs of organizations that are in turmoil and chairs of organizations that are incredibly well run. And Princeton has a very effective and well-organized board. And I was fortunate enough to be chair with two just truly stupendous people as president, Shirley Tillman and Chris Eisgruber. Be patient and be willing to invest against the crowd.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
So you're based in San Francisco. San Francisco is a bit of a technology hub, Silicon Valley and San Francisco. So do you think that technology valuations have gotten ahead of where they should be? And we've seen a diminution in those valuations, but do you think there's more to come, or do you think technology is still going to be a core part of our economy and you're going to see growth in those valuations?
Oh, I think that innovation, technology is actually the core of our economy. And I think that is really what is sort of one of the sources of optimism as we look out over what was definitely going to be a rocky period of time. And I think that that cuts across solutions to many of our problems, whether it be in healthcare or climate or others. So I think that that technology and that innovation is fundamental, and to be part of that is critical. But I also think we've gone through a period of dramatic inflation of asset prices, particularly in some of the highest growth things. I mean, the NASDAQ has compounded at 14% for the last 10 years. I mean, that's just, almost twice what kind of normal long-term expectations would be.
Now, I often talk about the technology deals that were brought to me, like Facebook, that I turned down because I didn't think they were going to go anywhere. If you live in San Francisco, I assume people are always coming to you at cocktail parties or seeing you somewhere and say, here's the next Facebook or the next Apple. Have you turned those kind of deals down, or do you always take a look at some of those things?
Again, we at Hall Capital are really disciplined in terms of sticking with investing with the very best professionals in the field. I know how hard it is to be great at any sector of investing, whether it be venture investing or risk arb investing or global equity investing. And so we don't invest in single companies at Hall Capital. Okay. We have been pretty aggressive in terms of investing with who we think are the most forward-thinking and best managers, including in venture.
Some of the best venture funds that are in San Francisco, for example, or in Silicon Valley, they're hard to get into. If you call them up and say, we're Hall Capital Partners, we want to get in your fund, is it easy to get in because of who you are, or is it still hard?
It's hard for everybody, in part because there's just limited capacity. But one of the things that we have done, I think, particularly well, is to align and cultivate relationships what were then the next generations. So, 15 years ago, to align with firms that were starting up that are now some of the leading firms is a place we have built some very good and productive, profitable relationships.
But if somebody came up to you in a cocktail party, let's say it's Mark Zuckerberg, and he said, I'm starting a new company, and my best friend is the best technology person in the world, this is going to be better than Facebook or Meta, you would say, that's just not what I do?
Yes. But I would say, probably interesting to do something, size it appropriately. So if a person has, X amount of capital and they're like, oh, this is the best thing ever, I'm like, okay, but size it appropriately. Don't put all your chips in that one basket just because you think that that person's going to be a hero. It is still, a startup company, and some of them have binary outcomes.
Now, recently, cryptocurrencies have been very popular. And if a client came to you and said, look, I'd like some cryptocurrencies in my portfolio, what would you say?
Oh, we've actually been really deep into crypto, deep into learning about blockchain, and all of the new businesses. I would characterize us as crypto learners. We have made a series of toehold investments on behalf of our clients, both in some of the currency baskets as well as with some venture firms that are investing primarily in the crypto area. I think it has the potential to be completely game-changing, but it is still such the Wild West, and it's so uncertain. But it has the potential to completely upend everything.
So what is the best investment advice you've ever received from anybody?
Be patient and be willing to invest against the crowd.
And what do you think is the biggest mistake that the average investor makes?
100% falling into the fear of missing out trap. And when someone just becomes obsessed with the short-term momentum trade and the short-term relativist, they inevitably buy high and sell low.
And if somebody said to you at a cocktail party, or they just came into your office and said, I've scraped together $100,000 and I don't have that much disposable income, but I'd like to invest and get a reasonable return, what would you do with that $100,000? Would you put it in an index fund, or what would you do with that $100,000?
Well, I go through the same set of questions that I talk about with people that have 100 million or a billion. You start by like, how long do you need this money for? What's their risk tolerance? And if it's capital that they don't need for the next 5 to 7 or 10 years, I tell them to basically either buy an index fund or buy a balanced fund and put it in a drawer and don't fuss with it.
And if somebody's watching this and says, I really want to be like Katie Hall, I want to be the owner of a money management firm, what would you say is the best preparation for that? Is it to go to Princeton, Stanford Business School, and then work for a number of years in a different area and then start your own firm? Or what would you say is the best way to get ready to start your own money management firm?
It's definitely about getting experience. You know, business school was very useful. I mean, I took mostly math classes, but that was fine. I would definitely, having worked in risk arbitrage for 10 years, gave me a completely different perspective about how to think about investing than sort of the, if you will, kind of the normal allocator, which I think was invaluable. And then I think you have to actually have the belief in your ability to make judgments and do it.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Rose is a trailblazer. In 2019, she became the first woman to lead a major UK bank when she was named Chief Executive and Executive Director of NatWest Group, the place she's stayed since starting her career as a graduate trainee 30 years ago.
It was always, for me, the next job was more interesting, the next challenge was more interesting.
Her current role is her most challenging yet, taking the helm of a lender that had to be bailed out by the state following the global financial crisis, and steering it through the multiple disruptions of the COVID pandemic, Brexit, and the war in Ukraine.
Yeah, I'm feeling okay about the future. I'm very conscious of, you know, the challenges that are facing people, but I think there is a lot of resilience in the banking sector and in the corporate world that can help.
As she looks ahead, she's determined to innovate, to embrace new technologies, and reform financial structures that have deepened inequalities.
Some of the work that we did around addressing some of these barriers has made a difference. We've seen a real increase in female entrepreneurs.
But she also tells me that she wants NatWest to get back to basics in serving customers.
I describe it as a relationship bank for a digital world. Actually, it's really important that you build a relationship because you can go anywhere, do anything. But it's much more convenient, and that's what banking should be.
Thank you so much for joining us on Leaders with Lacqua. Now, you started as a trainee. Do you remember that first day?
Oh gosh, yeah, absolutely. I joined the graduate scheme, and I just remember joining with a bunch of graduates, and you did this great rotation where you tried lots of different jobs, and my abiding memory was I had no idea what I was doing. You know, banking from the outside in is really complex. And just being really nervous and not really knowing what I was going to do, and then sort of launching myself into this graduate training program, which was great fun.
And here you are as chief executive. So do you think sometimes of what kind of leader you were back then, or you thought you were back then, and what you are now?
I had no concept when I joined that I would be CEO. I was, you know, it was all about trying to learn. I really thought I'd be in banking for 2 to 3 years and then go and do something else. You know, I think the great thing of being a graduate and going through an organization in any career, you get to see different types of leaders. And so as you develop your own leadership style, you sort of borrow from other people, and then you find yourself. I mean, that's the whole thing about as you start a job, you kind of learn about yourself as you go and acquire different skills. So I had no idea at that point or view that I would become the CEO.
But so what made you stay?
It was always, for me, the next job was more interesting. The next challenge was more interesting. So you know, my HR team always, you know, hold their head in their hands sometimes when I say I didn't have a 5-year plan or a 10-year plan. It was, what was the next most interesting job? And it was always an interesting challenge, and it was always with great people. And I think those are two really important ingredients in any career or any firm. Work with great people, work with great teams, have jobs that challenge you.
What's your biggest challenge right now when you look at how you lead the team? Is it motivating people? Is it keeping the workforce on side? Or is it actually, you know, strategy and shareholders?
Yeah, I mean, all of the above, right? And I think being the CEO of any organization today, you're having to balance all of the needs of your stakeholders. I mean, I've deliberately set my strategy of being a purpose-led strategy, and it is about keeping my customers happy, my communities happy, my shareholders happy, all of my stakeholders happy. But I think the biggest challenge of any CEO or any leader right now is the world is so uncertain and moving so quickly. So you have to be able to lead through ambiguity and with authenticity. And of course, what most people want is, tell me what the answer is. And that's what we're all having to explore.
You've been chief executive for just over 2.5 years, and at the time it was really, you know, focusing on the environment, focusing on ESG. We've had COVID since. Now we have a war at the, you know, the footsteps of Europe. How has that changed you as chief executive?
I think it's meant that I've had to be much more hands-on. I was always, you know, quite hands-on anyway, but I think when I took over as CEO, when I spoke to the team, I talked about creating a learning organization and how the world was changing so fast and it was very unpredictable, and we had to stay really close to our customers and be able to work with them and build a tight relationship. That's never been more important than through the pandemic or through this horrible situation we have with the invasion of Ukraine. So I think what it's really centered for me, the importance of, you know, clear leadership, clear direction, but also understanding, the balance that people have in their lives. And for me, leading, banking is a service-led organization. Stay close to your customers, support them through their lives, and make sure you drive a very clear path for your colleagues.
Do you think the reputation of banks has really changed in the last 10 years, or is it frustrating that, sometimes clients, customers see you as the app instead of understanding exactly what you're trying to achieve?
Yeah, it's always hard to get over, what a bank does and what it is. We provide, the fuel to the economy that creates jobs. We provide huge amounts of support to communities and big education programs, and we, provide banking. But banking is almost seen as a utility rather than a service, and so we're always balancing those. And I think, since the global financial crisis, banks lost trust. It takes a long time to rebuild that. So you have to do that customer by customer. But I think the reputation of banks is improving. I think we stood up during the pandemic and we were there to support customers and were part of helping keeping the economy going. And hopefully the value of the banking sector became clearer.
The government now owns less than 50% of NatWest. How did that feel on that day?
It was a good milestone. It was a really important milestone, especially for colleagues. When I took over, the government held 64%. They've been a great shareholder, but getting below 50%, no longer majority owned, is just, a testament that we're delivering the right strategy and delivering value. But I think for a lot of colleagues, it was a milestone moment. Day to day made no difference. I think we had a gentle nod to say excellent, and then on with the job. There's still 48% to go.
Coming up, Alison Rose tells me she believes the UK economy is making a strong recovery from the pandemic, but NatWest customers are still adjusting.
With rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it is causing quite a lot of anxiety.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Alison Rose has spent her entire career in finance and NatWest, starting as a graduate trainee straight out of Durham University 30 years ago. She became chief executive in 2019. Now, as the UK recovers from the pandemic, she's been taking the temperature of the bank's customer base as inflation, rising fuel prices, and conflict in Ukraine cloud the economic outlook. We discuss what she's observing on the ground. we overlook, St. Paul's and the City of London. You're so intricately, intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it's very different, and it's not something people have had to operate in for a long time.
Do you feel more stress than at the beginning of COVID? It's very different. I mean, some customers will be able to pass on, of course, some of this inflation onwards, but then you'll have, a lot of families going through quite a lot.
Yeah, it's very different, and I think it's the experience is very different everywhere. At the moment, we're not seeing signs of stress in what we would see in our data around distress or loans or people asking for requests for help. So it's mainly concerns. But with fuel price rising, for the lower income families, it is quite distressing. At the other end of the scale, you've got a huge amount of liquidity sitting in the economy, on corporate balance sheets, in businesses, from all the quantitative easing that's been done. So you've got a number of things, pulling against each other, which makes it very complex. So I think it's really an important time actually for banks, again, to be really important because we can provide practical help and support to people.
So what kind of questions do you get?
I mean, it varies. We get a lot of questions from business owners about how they manage disruption to supply chain, how they can fund their working capital, how they can restructure their pricing mechanisms for families. It's how can they save money, in terms of the money they're spending to afford the increase in fuel prices that are coming. And we do something called a financial health check, where invariably we can save people money by bringing their finances together. So it's that proactive conversation.
What about mortgages? What are you seeing in mortgages? And if mortgages go up, do you worry about some kind of credit crunch or people not being able to pay that?
Well, mortgages are, again, this is a sort of counterfactual. The mortgage market continues to remain very strong. Demand for mortgages remains very strong. And for us, the majority of our mortgages are on fixed rate mortgages. So the interest rate rises are not causing an immediate problem. Same with businesses, actually. 50% of our small businesses are on fixed rate borrowing. So you're not getting increases coming through.
For now, but then in 1 or 2 years, I guess that stops, right?
Yeah, I mean, I think as you come off the fixed rate, what will the rates be at that point? I think it's about helping people plan and think ahead. What is going to happen in 2 years' time? Where will inflation be? The Bank of England are putting through interest rate rises to try and bring inflation down. The invasion of Ukraine and the disruption to the geopolitical environment is causing stress. So I think it's calm heads are needed right now to navigate what is uncertainty and making sure that businesses and families have got the right support.
Worst case scenario, could you see zombie companies or companies going under? Or because we've had that support during COVID, we seem to be a bit more resilient to what's coming?
I think there's a lot more resilience. I mean, what is astounding, if you look at how businesses in the UK performed during COVID, I don't think anyone would have predicted they would have been so resilient. And yes, there was a lot of support put in place to do that. But, businesses did think about what was their supply chain like. They did think about, innovation and technology. They did think about how they managed their workforce in a different way. So there is a lot of resilience.
So does it mean you're feeling okay about the future?
Yeah, I'm feeling okay about the future. I'm very conscious of the challenges that are facing people, but I think there is a lot of resilience in the banking sector and in the corporate world that can help. There is a bit of a buffer there that can support. So I think we just need to navigate that, and hopefully inflation will settle down. I do think things are exacerbated right now because of the invasion of Ukraine and what that's doing to supply chains and the geopolitical impacts. But I think it's just really important to try and give good advice, sensible advice, and plan sensibly.
So when you travel across the country, it's also extremely interesting to hear your thoughts on, of course, some of these regions and how different they are. We talk a lot about levelling up. Has it worked out in the UK?
Yeah, well, I mean, we as a bank are a really regional bank. Most of our business is outside of London. And one of the things I would say is the economies outside of London are very different. You know, there are different concentrations. We've seen great growth, for example, in technology in the north. You know, we have huge teams in Manchester where there's a real hub of technology and innovation. We have innovation and accelerator hubs up and down the country. And so you are seeing different growth, but there are different communities that need a bit more support and a bit more levelling up. And actually the green agenda, the climate agenda is a real opportunity to create that because it's going to contribute to new jobs, more jobs. Actually, the flexibility created from the pandemic, working from home, means you can create and hire people around the country. So I think there's a real opportunity, but I think it's really important that everybody recognises the different economies and the different trends that are.
Why is it still so difficult for women entrepreneurs to find funding?
Yeah, I mean it's a complex question, and it's really frustrating because there are so many female entrepreneurs in the UK. Lots of reasons. Lack of access and awareness of financing is definitely one. A very shockingly small amount of VC money goes to female entrepreneurs. It's only 1%. We think it's gone up to 5% as a result of, but that's still shocking. It's shocking, and it's mainly investment teams are all male. They'd say they're not seeing the pipeline, but we're seeing amazing entrepreneurs. Some of the work that we did around addressing some of these barriers has made a difference. We've seen a real increase in female entrepreneurs. The number of businesses opened and run by women last year went up by 33%. So 156,000 new businesses opened by women. And really excitingly, the biggest growth area was in the 16 to 24-year-old age group. But it's still too hard because it's geared to perceptions of what a business leader should be, what an entrepreneur needs to be successful, and yet you have this amazing group of female entrepreneurs. So it's moving, but not fast enough.
Does it change the working from home because of the pandemic? Does it change, does it help or actually hinder women?
Well, I think in the short term it hindered because what we saw, unfortunately, is one of the big barriers to female entrepreneurs is family care responsibilities disproportionately fall on their shoulders. And during the pandemic, with working from home, that became exacerbated. And we found that 70% of female entrepreneurs found running their business in the pandemic more stressful than men. It was only 55%. And for women, they had to take 6 out of 10 days for caring responsibilities versus men, 1 out of 10. So it made it worse. However, the fact that networking could be delivered digitally online and it wasn't in a very old traditional way, the fact that you could bring teams together and work remotely is definitely an advantage. So as we come out of the pandemic with those family care responsibilities diminished, then I think the digital and technology will help, which is why we've seen this big increase and more direct, practical help for female entrepreneurs.
Did you feel any of those pressures during the pandemic?
Yeah, I mean, I was running a bank from my office at home, and both my children were at home and not at school. My daughter was going through her A-levels. My son was doing online learning. So, it's definitely a challenge. My husband was brilliant. We shared it, but it is a different dimension of stress that you feel.
Coming up, Alison Rose talks fintech, crypto, and explains why banks have to focus on relationships to stay relevant in a rapidly changing world.
Banks have no reason to exist unless our customers want us to exist. We provide capital and fuel to the economy, but we need to make sure we're serving them and working with them.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now. Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
As the first woman to head a major UK bank, Alison Rose is a living example of one way that finance is changing and evolving in the 21st century. The industry is also transforming through technology, with physical branches increasingly giving way to digital interactions. We discussed what this shift means to the business of banking.
How has the relationship between a customer and the banker actually changed? I remember like 15, 20 years ago, people would go into branches and have this like personal relationship. Now you're spending so much money on the app because a lot of people don't need to speak to someone. Yeah. So how do you reconcile the two?
Yeah, I mean, banking's changed massively. I mean, what I'm trying to do with my strategy for the bank is I describe it as a relationship bank for a digital world, because it is a relationship. You have to have a relationship, but a relationship can be delivered in a very different way. For example, NatWest now, 60% of our retail customers only deal with us digitally. We are a digital bank. Yeah. 90% of their transactions can be done digitally and online. So the way banking happens is changing. The mobile app, video banking. Now, that before the pandemic, we do 100 a week. We're now doing 16 to 17,000, and it's much more convenient. So I think it is the sign of how technology is evolving, how customer behavior is evolving, and it is much more interactive. So actually, it's really important that you build a relationship, because you can go anywhere, do anything, but it's much more convenient, and that's what banking should be.
But how do you measure success? Is it a customer that will have every product with you? The number of products or a number of good reviews?
It varies. I mean, we measure it through NPS, so that we make sure, which is our customer satisfaction scores. We measure it through meeting the needs of our customers through their life cycle. So it's great that we have grown our market share with youth customers up to almost 16% now. But what success for me will be in 20 years' time, those young customers will be existing customers of the bank, and we'll be helping them with their house, we'll be helping them invest for the future, we'll be doing all the things that really matter. So we look at it as part of our purpose strategy to build long-term value, so our customers stay with us and grow with us.
Any M&A on the horizon? I mean, there's always rumors flying around that you're either buying someone big or you're being bought.
Yeah. No, I mean, one of the advantages I have now with the bank is, we have, lots of capital. We've got a capital generative business. We're investing $3 billion. We're paying very substantial dividends, and we have capital to invest in M&A if there are compelling reasons. But for me, there's got to be really compelling reasons why I would like to acquire, because we're on a path of a great transformation plan. Things that we're building ourselves, partnering is a really important aspect of what I want to do. So I will look at M&A, but only if it makes really strong, compelling sense for shareholders.
How do you see the banking sector actually changing in the UK in the next 5 years?
Yeah, look, I think we've got to be, it's much more open architecture. Technology and data is really transforming not just how customers work, but how we work. And I am a great believer in bringing partners in. I'm building a real partnership strategy, because doesn't always make sense for me to build it myself. And also, I think the definition of place is changing. You can't rely on customers to come to you. Our customers are, in the metaverse. They're, in TikTok. They're somewhere else. So we've got to build the relationship and go where they are. So I think partnership, technology, data are all going to be part of it. But we're an intrinsic part of people's lives, and that's a very privileged place to be. We just need to make sure we stay there.
In the metaverse, is it to have a presence? Is it actually attracting customers in the metaverse?
Not yet, but I think, clearly the boundaries between the virtual world and the real world are very different. And a lot of, you know, a lot of our younger customers move very effortlessly between different places. So we need to make sure we stay relevant. I mean, banks have no reason to exist unless our customers want us to exist. We provide capital and fuel to the economy, but we need to make sure we're serving them and working with them.
What does it mean for crypto and fraud?
Yeah, I mean, crypto is a real challenge. It's a new technology, but it's also, we're seeing very significant amounts of fraud coming through that. And fraud generally in the UK is, you know, we've talked about it being almost, you know, pandemic proportions, because people are, you know, being defrauded constantly. I mean, last year we stopped over 355 million of fraud against our customers. I mean,
online?
It is through a mixture of online, through romance scandals, through very simple impersonation scandals. And so making sure we can protect our customers and inform and educate them is really important. And crypto is a new innovation, a new technology, a new currency, still developing, but there are quite a lot, and there has been a high proportion of investment frauds using crypto. So we're working really hard to develop defenses against that to keep people safe.
Rapid fire questions. Okay. Best piece of advice?
Don't sweat the small stuff.
The worst piece of advice you've ever been given?
Worst piece, try and be like someone else.
What would you tell your 20-year-old self?
Go for it and believe in yourself, and just be yourself.
Who's someone that you admire?
My late father.
Because?
He was high integrity, very courageous, and believed in me, and was a good man.
What does it mean being an entrepreneur in the UK in 2022?
Being an entrepreneur is taking a risk and having all of the opportunity. This is the most entrepreneurial country there is, and the opportunity to start a business and grow and thrive is really exciting. But it's about having an idea and going for it.
You're so good. I have like 25 other rapid fire questions. Where's Alison Rose in 5 years from now?
Doing something I love.
Which is?
Whatever the next challenge is.